which hopefully you can see, is a quote from the IMF, which recently came out in one of their publications, which highlights, I think, something which is going to be an increasing trend and theme, not just over this year, but really over the next few years. And this is basically all about the dollar and who controls the world monetary system. And we can see here the dollar is basically ultimately, or here, losing favor. The comment that we put underneath just brings out another few points. I think it's well worth putting this in the background of what I'm about to say. These are just illustrations of how China is financializing and the increasing power that the Chinese system basically has. We're not in the camp that says the Chinese economy is about to derail. The whole thing looks, something which is about to flop any moment. That's just simply not the case. And what you can see here in some of the evidence that we cite is that the People's Bank is pushing out its digital currency initiative. There's been evidence in recent days that Russia is actually also announcing a digital currency which looks remarkably like the Chinese model, and you can see how much China is actually positioning itself, in terms of this whole space. And it's one of the things that China needs to do to, if you like, consolidate its power. Now, to come down to the more nitty-gritty of what's happening right now in liquidity, the data that you will be seeing is basically data that is all about effectively the last month, the end of March data. So it's very up-to-date data. For those of you that are unfamiliar with global liquidity, let me just give a sort of snapshot as to what we look at. You can see in this illustration that basically global liquidity is a big pool of cash. It's something like twice world GDP. It's growing clearly a lot faster. It's been the initiative behind the recovery in world economic activity and markets over the last 12 months. Those people that still don't believe that liquidity is important must have been living in a different world for much of the last 12 months. It's been clearly the critical factor. What we do in understanding liquidity is that we measure liquidity. It's one of the key things that we're tasked with. And basically, as that slide says, the most important thing is looking at the capacity of capital in the system, not the cost of capital. And we measure global liquidity effectively by looking at balance sheets. So it's balance sheets of all lending institutions, including central banks, including high street banks, and including what are generically called shadow banks. And the reason that liquidity is so important to the system is that there's a huge amount of debt out there which basically needs to be rolled over. It's not about the new financing of debt, the interest rate that's a critical thing. It's about the capacity to refinance debt when it becomes due. And if you can't refinance, you get a financial crisis. The key points of what we foresee for this quarter are highlighted here. Some of those you'll be familiar with. They've been continuing themes, but basically what they say is that liquidity is continuing to expand. However, it's true, as I will demonstrate in coming slides, that there is an inflection going on in terms of the slowing down of liquidity, in terms of the growth rate. It's still expanding, but now at a much slower rate. Nonetheless, the liquidity we've seen in the course of the last year or so has basically meant that you're getting a V-shaped economic rebound, and that's clearly critical for policymakers and really the outlook over the next year to 2 years. Strong economies, however, very rarely have strong financial markets, and that's one of the factors to watch or to be very cautious about. Ultimately, what you're getting is yields rising, particularly in treasuries, government bonds. We think the US Treasury, which is sort of the linchpin of the global system, is likely to test 2 to 2.5% yields ultimately. They're well on the way there, sitting at around 1.6 to 1.7% right now, but they've come up a long way this year. If you think we began the year at just over 1%, so there's been already a significant move in rates going upwards. And that, as we will highlight, is a headwind because it tends to detract from collateral and collateral is important for liquidity generation. So steeper yield curves, that means rotation towards value cyclical based equities. Growth is going to labor under the prospect of higher rates, growth stocks that is. Inflation is a threat, but it's not really a major problem. And what you're likely to see is benefits coming through to further gains in commodity prices and real assets. We tackle the issue about gold a little bit later. Is it still an inflation hedge? We think it probably is still, but the question is, could Bitcoin take over? Well, I think it already has, but there could be a lot more growth for both of these two assets. China, we think, is still easing. That's a non-consensus view, but basically, as we highlight there, February was actually the strongest month for almost 12 months in terms of their liquidity injections. The vulnerability of markets, risk assets and equities in particular, to a Q2 or Q3 correction is still out there. And that's coming not because of valuation levels or anything else. It's coming much more because of the strength of economies just pulling liquidity away from financial assets. And then we come back at the end towards this issue about the dollar. Is it in long-term decline? What's happening effectively to currency policy? We think that there is a picture of long-term dollar decline. And basically, one of the things that we've talked about a lot in recent months is the whole question about Asian currency targeting. And that's what it looks like is going on in that region. Now, let me drill down into the data. Here you see our index of global liquidity. This is going back to the mid-1960s. As you know, we've been updating this regularly for sort of 20 or 30 years real time. So you know, what you see is the unfolding liquidity picture. The data is shown as an index between 0 and 100 with a 50 mean and a 20 unit standard deviation. Where we are now is liquidity levels of around about 80 or just shy of 80, puts us at very high levels, but you can see there's an inflection going on, and that inflection is saying that basically the pace of liquidity injections are now beginning to slow down. That's not really because central banks are tightening, although one of the things that I'll come on and say is that there is some evidence at the margin of non-central central banks, if that's the right way of putting it. Some of the peripheral central banks are actually already starting to tighten, and that must be a watchword looking forward. But the other reason is strong economies, just pulling money out of financial assets. And that's really the main reason you're getting this downward inflection. In terms of a heat map of who's easing and who's not, this chart basically shows what's going on among central banks worldwide. What you can see on the right-hand scale, or the axis there, is showing which of those countries each one of those rows refers to. The world is at the top, then developed, then emerging markets, then the US, Eurozone, China, Japan, UK, etc. You can see some central banks are beginning to tighten a bit. The China line shows that actually China is not necessarily tightening, but it's actually beginning more easing. And that's how we see it. It was tight through a lot of last year, but it seems to be adding more liquidity, and that's the sense we get from the data. Switzerland, Australia, and possibly India at the bottom are seeing those green bars begin to sort of turn more paler and moving towards orange, which is, you know, suggesting a degree of tightness coming in. So if you look at all central banks, the 80 central banks we monitor, something like 83% are running loose policies, and that was around 88% 2 months ago. So you can see the trend is downwards. But then if you go back a year to March of 2020, I think it was only about 33% of central banks were actually running easy policies. So we've got to remember that this is very cyclical. What does it mean for economies? This is an index that we sometimes show, but it effectively gives an idea, a snapshot using daily data of world economic momentum. And basically what that is showing, it's from the scale at the bottom is a little bit misleading, but it's starting in 2020. and that data is daily data. And what we do is we basically create mathematically a principal component or common factor that we extract from all economic data releases that come out worldwide as published on Bloomberg. And this is the principal component, the sort of mathematical common factor that you see there. So it's designed to show the economic cycle. And I think you can broadly say, although it's not absolutely true, that scale could be something like GDP growth. So it gives you some idea about the momentum of the world economy. It's not exactly that, but it would be pretty close. And what you can see is that the tempo of world economic activity picked up in a V shape. There was a very strong rebound. So this is, as I say, detecting economic surprises. And those surprises have persisted. And actually, as we come in from end March into early April, the data goes up to the end of last week. What you see there is there's been a further pickup and positive surprises. And I think a lot of that was sort of underscored by the US ISM index. Now, if we move on to the bigger perspective, this is showing economic activity going right back to 1992 using world business surveys. And these are the sort of the headline surveys like the US ISM, the Tankan in Japan, the UK CBI survey, etc. And they're just put together GDP weighted, and we put on top of that on the red line an index of world trade activity, which is actually a series of sub-indexes of shipping, shipping freight rates, but shipping volumes too, and including container traffic, etc. And what that shows is actually a broad confirmation that we've seen this V-shaped recovery. So effectively, a lot of the economic angst of COVID is kind of behind us in terms of what this data is saying. And that's certainly what financial markets are beginning to suspect too. If we move on to markets and the equity outlook, let me start with this chart, which I think pretty much says all you need to say about liquidity and financial assets. And what this shows is the yellow line is illustrating the path of global liquidity. We go through, the projection is to the end of 2021. So this is taking into account the inflection that we're now beginning to see, but we've projected that forwards. And the red line is the growth or the return, if you like, the same thing, of world financial asset prices. So that's all quoted bond prices, all quoted equities, cash instruments, includes precious metals, and these are primary asset classes. If we included housing in that, it would give exactly the same picture. But basically what that shows is liquidity is a major driver of financial asset inflation, as we've long suspected. Yet another piece of evidence through this cycle that's underway, and liquidity is leading, as you can see clearly in that diagram. What does it mean for financial assets? It means you're probably going to get some further gains, but we've got to be very cognizant of this downward shift and loss of momentum that's coming through. On a more straightforward valuation measure of just looking at the relationship between the value of all equity holdings shown here divided by that pool of liquidity. So if you take the pool of liquidity, as I say, representing about 155 to 160 trillion dollars, the ratio of equities to that pool comes out right now at about 0.57. Now, what does that mean really? Well, that's a ratio. The history of the ratio is shown. You can think of it rather like a price earnings multiple equivalent. So it's not dissimilar from a PE, but we think a much more accurate representation of what's going on. The peaks that you see in year 2000, 2007-8 were clearly market tops. Those occurred much, much higher equity to liquidity ratios, respectively of 0.85 in year 2000 and 0.71 in 2008. Where we are now, 0.57, is basically well below those earlier peaks. The markets still haven't got back to the earlier, more recent peaks that we saw in 2015 and in late 2016, or sorry, 2017, those periods we're still shy of that. And if you add in the increase in liquidity that we suspect is coming through year end because of commitments that central banks and fiscal authorities have already undertaken, what you get is that ratio falls back to 5.51, which is around the long-term average of that data series. So as far as we can see, there is no evidence in general of bubbles in markets right now. There may be pockets of that, but basically overall there's no evidence. Let's come on to look a little bit more detail at the equity outlook. And what we argue, and I've been through before, is what drives the three main asset classes. And just to recap, for fixed income markets, it's the direction of liquidity. For Forex markets, it's the quality mix of liquidity between private sector and central bank. But for equities, it's the positioning of portfolios with liquidity and how much liquidity is being held in portfolios as part of the safe asset mix. And what you see here on the left-hand side of the graph of the page is a mountainscape which illustrates different asset classes. So what we have here are all equity holdings, all liquid asset holdings, all fixed income holdings, and precious metals. And that is shown in terms of trillions of dollars. So you've got a pool there of about $260 trillion. And that is divided into those various assets that you see. Basically, what we're arguing is that there is a normal asset allocation that goes on. So if you look at long-run trends, the equity part of that portfolio would be pretty constant over the long term. There'll be clearly fluctuations, but equally with bonds, there's, if you like, an underlying asset allocation, which may be a sort of 60-40 bond equity bond split, for example. What we do then is we look at deviations away from the trend in asset allocation. And the graph on the right-hand side is the relationship between risk assets, which is dominated by equities, but includes corporate debt, divided by safe assets, which is government bonds and cash. And that average, or that red line on the right-hand chart, is the deviations away from the average, the 5-year average in that series. So what this is basically illustrating is a very neat way or straightforward way of showing the risk on, risk off behavior of investors. This is not a survey, so it's not, I aspire to doing this. This is actual data from holdings. So it's very up to date as well. We get this, in this case, for 80 countries monthly, but for a smaller sample, we can get that data daily with about a 2-day delay now. So it's very up-to-date data on investor positioning. What this basically illustrates is two things. One is that if you look at equity positioning within portfolios, it's, for the world overall, it's still around about normal levels, which is actually what that earlier graph, the previous graph, pretty much showed. The yellow line that you see on top of that is world economic activity, world GDP growth, in fact. And you can see that asset allocation is very, very pro-cyclical. So there are overshoots in the red line, but typically if you get an increasing economic cycle, investors move more into risk assets, in other words, more equities, less debt, or less government bonds, less safe assets. And then equally, if you see a recession or downturn in the economy, then they tend to shuffle off very quickly into the defensive areas like safe assets, cash, and government bonds. Where we are now is that investors are moving upwards in the risk cycle. They're putting risk on, and according to this chart, they're nowhere near their normal saturation points. That comes at around about the 40 mark on that left-hand scale, which is about a 2 standard deviation move above average. We're nowhere near that for the world overall. If we look at the big markets, the 4 big markets are illustrated on this graph. And what you can see is the US, Eurozone, Japan, and the UK. Now, the point that we've made, I think, somewhat repeatedly in recent months is to say that although markets have rebounded a lot in terms of price appreciation over the last 12 months, the fact is that they really did sell off a year ago. And if you look at Wall Street in particular, what you see there is that risk positioning index, the risk exposure, if you like, went right down below the -80 level. Now, this is a standardized normal series, which basically has standard deviations, as I say, at minus, what, 20 units. So -60 is 3 standard deviations, and -80 is 4, which is almost an unheard of deviation, as you can see. And in fact, Wall Street, in ranking markets, was right at the bottom of all market assessments in terms of risk exposure as of a year ago. So US investors were the most beaten up and most pessimistic of all investors worldwide this time in 2020. And from there, you've seen a massive rebound in markets, and that's what you're getting. But it's still not at the saturation point. We would get worried when that red line, which it will do, goes up towards 40, plus 40. It's not there yet. If you look at the Eurozone, you've seen a similar V-shaped bounce, but the Eurozone, like other markets, didn't sell off as much as Wall Street relatively. And if you look at where we are now, it's above where the US market is, probably with evidence that the Eurozone economies maybe don't have the same momentum as the US does. So there may be a little bit of caution to say that in terms of relative asset allocation, which I'll come on to. Japan, similarly to the Eurozone, looks a little bit elevated. It's near its 40 saturation point. The UK is still below or very close to that lower band. It's picked up a bit, but not too much. So there's a lot of opportunity we still see in the market. Now, if we look at this on a daily basis and we go back to the beginning of 2020, you'll see that more clearly here. These are the individual risk exposures for 4 countries. I've replaced Japan with China here. And the reason being is that China's certainly in the short term a bit more interesting, in the sense that risk exposure is now coming down quite clearly there. But if you look at those 4 lines, what they illustrate is in a bit more detail is what I already just described. There was a sharp V-shaped increase in US exposure. So this is this is data on actual investor positioning, I stress again. And US exposure has been roughly around neutral, that 0 line, for much of the last few months. And it's beginning to tick up a bit, but it's only really towards that 1 standard deviation mark, looking at the yellow line. The black line is Eurozone and aggregate, and you can see that's touching the plus 40, not quite there, but it's getting there. So that gives us a little bit of concern, maybe the markets are a bit too stretched there. China, as I said, has come way down, and the UK is still at 1 standard deviation below average. So there's a lot of scope still, we think, for UK stocks to move up. And if you look at the profile of the UK market shown here, positioning, you can see that there was a little bit of a recovery after the after the first COVID sell-off. But then positioning went down again, particularly around August, September, October. And that was really at the height of the Brexit concerns. So you can see the damage that Brexit basically had in terms of positioning or sentiment in the UK market. Given the fact you always get mean reversion, you're now seeing investor allocations picking up again. In terms of a ranking, which gives a better idea as to the relative opportunities across the whole universe of equity markets, this is showing all the data of markets that or the major markets we cover. There's actually a whole lot more of frontier markets that I haven't put in here, but this illustrates risk exposure by market area and aggregate. The red bars are sort of regional blocks, so Eurozone, all developed markets, world overall there, and all emerging markets. If you strip China out of the all emerging market category, the ex-China emerging markets is much nearer the top of that ranking, or would be. It's sort of pretty much where Korea, Taiwan sit there. And if you look at the flavor of this chart, what it's really saying is that around the top of the ranking, which is saying risk exposure is very high, so that's where we'd be a bit more cautious at those high ends. So things like traditional defensive markets, Netherlands, Switzerland are up there. Cyclicals like Korea and Taiwan, based around semiconductor demand, are up there. Russia's there, I guess, on oil grounds. Sweden, which is a traditional cyclical market, is also benefiting from that. France, I'm not sure why that's there, but it's but investors have clearly positioned towards French equities. At the bottom of the graph, what you see is the UK, South Africa. Again, South Africa could well be attractive as a commodity play, but Canada is down there too, as you can see in the lower rankings, and Australia is barely above normal exposure. The US, which you can probably see about 1/3 of the way down, is still not anything like the valuation extreme that many people argue from a PE basis. In terms of positioning, Wall Street is looks fairly well supported on this, at least on this evidence. But what we would argue is that you want to be shifting more towards the lower end of this ranking, because that's where you've got greater opportunities. Let me move on to China and commodities. And there are two charts in this section. This is the first one, which I think maybe highlights what we're arguing, maybe quite well. What it shows is our policy liquidity index for China. So this is measuring People's Bank of China liquidity injections on a monthly basis, but shown as an index between 0 and 100, and a normalized index between that range. And the other line, the yellow line, is looking at the Liquidity index, which is, for those of you that don't know, Liquidity is the premier of China, the sort of #2 there, and is, if you like, largely in charge of economic affairs. And he, some years ago, said, well, don't believe Chinese published data or the GDP data. He said, what I tend to look at is X, Y, and Z, which tends to be things like electricity prices and transportation rates and whatever. And Bloomberg put the Liquidity index together, among others, and that's shown as reported. And it's a pretty good guide as to what the Chinese economy is doing, although it can be, as you can see, a bit volatile. Nonetheless, it corresponds almost exactly to our policy liquidity index. As you can see, the two correlate very closely, and they're completely unconnected. I mean, they don't have overlapping variables at all. So what that is trying to illustrate is that the impulse in terms of liquidity by the Chinese that we're detecting is coming through in terms of economic activity. Now, one thing I ought to stress is, why is our data on liquidity so different from the consensus? The consensus has been jumping up and down for much of the last 6 months, saying that China is tightening, is going for ever more tightening. That hasn't really happened. The evidence we've got is that China's been progressively easing, not that aggressively, certainly relative to what the US or Eurozone has been doing, but it's been doing it nonetheless. It's very difficult to detect accurately sort of the position of the People's Bank through Q1 of every year, largely because there's lots and lots of seasonal distortions, and it makes it very difficult. We make an attempt to do that, but the first quarter is notoriously hard. And the reason being is that China is still a very agricultural economy, and there are clearly big credit demands from agriculture, which tend to distort things. And secondly, the Lunar New Year holiday, which is a floating holiday that comes in Q1. And that can have very, very big effects in terms of distorting liquidity. But even looking through that, which we do here, it seems to be a robust indicator of economic activity. So according to this, the Chinese economy should be robust. And I think all the companion evidence that you're seeing in terms of import growth, export growth, etc., seem to be underscoring that view. This next chart is looking at the CRB index, the Commodity Research Bureau Index of World Commodity Prices. This is shown as a year-on-year change, and we've got, this is latest data end March, and we've put here, it again against the Policy Liquidity Index for China. And what this shows is a pretty straightforward story that China is a big industrial economy, a major manufacturer and user of commodities, and what you see is, what you get here. If they ease policy, it stimulates the economy, and in China in particular, I should stress that the economy is very, very sensitive to what the People's Bank does, because that's how the whole system works. The People's Bank deliver cash or liquidity to the state-owned banks, who give it to the state-owned enterprises, which tend to be the main driver of the Chinese economy still. And what you see here is that evidence that it has a marked effect on commodity prices. And again, if you think the Chinese economy is picking up, you still want to be going long commodities. What does this mean for inflation, for the gold price, and for government bond markets? Let me come on to that. The first thing to say is, what type of inflation are we getting? And what we've tried to do in this chart is to look back at US inflation and to split out the various elements of the components of US inflation in terms of what we think of as monetary inflation, which is basically increase in the effect of the increase in money supply on prices. That tends to be, a variable effect, but we pick it up by looking at how asset markets in particular are performing, to try and get some gauge as the impetus of monetary growth on prices. US cost inflation is shown as the yellow bar, so that's really things predominantly wage-based. And then there's commodity price inflation, which is basically the way that we calculated that is actually just to use the published numbers that the US Bureau of Labor use in their calculations of the CPI, which is the difference between core inflation and headline inflation. And that tends to be commodity prices, particularly energy. So that's what you see in the chart. Now, the reason for making that distinction is that the gold price is much more likely, in our view, to be a hedge against monetary inflation than general inflation. No reason why it should hedge general inflation, but lots of reasons why it should hedge monetary inflation. And that's what the evidence shows, which I'll come on to. But the main point here is that we are getting, reasonable amounts of monetary inflation, and we have done over the course of the last decade or so, which is actually why you've seen the gold market pick up. The gold market was in the doldrums for quite a while, through the 1980s, when you saw basically not very much monetary inflation. And clearly it is hit when you see monetary deflation, when those red bars go below the zero line. Going back to the 1970s, there was a lot of monetary inflation, which is why the gold market was then very, was buoyant at that time. This year, 2021, we think you're getting, underlying inflation in the US probably about 4%, of which around half of it is monetary in our estimation. What is the evidence that gold hedges monetary inflation but not CPI inflation? The evidence we put here is by looking at the long-term trends. This is a log scale of gold prices shown in yellow, appropriate enough maybe. The black line is looking at the trend in CPI, and the red line is a similar trend in liquidity data in the US. And what that suggests to me, and the evidence seems, I think, quite compelling, is that the gold market tends to follow the liquidity trend much more closely than it follows the CPI trend. In other words, it's a hedge against monetary inflation. And if you get monetary inflation, you should be seeing stronger gold prices. Now, this is the evidence from running two regression models on the gold price against where the gold price actually is, and the two fitted models. The red line is looking at liquidity as a driver of the price of gold, and the yellow line is a real interest rate model. So that basically uses CPI inflation, and it uses interest rates in the US interest rates as a factor. Now, one would suspect, although I've noticed that people are not necessarily buying into this view, but it should be the case that you've actually got low real interest rates and maybe negative real interest rates in reality. And that should mean that the gold market is actually pretty elevated on past experience. Admittedly, those real interest rates may be rising, but notwithstanding the fact that if you look at the estimates that come out of both the real interest rate model and the liquidity model, they're telling you that the gold price should be over $2,000 an ounce, and it may well jump there. The issue that we tackle in a recent research report is to say, well, what about Bitcoin? Has actually Bitcoin dented the sort of the glamour of gold as an inflation hedge? And the answer is yes, it has. We estimate that Bitcoin has probably taken $200 out of the gold price just by its existence. So if you spread that monetary inflation hedge across the size of the Bitcoin or cryptocurrency markets, that's the degree of magnitude that Bitcoin and others have basically taken out of gold. Now, the interesting question or conjecture from there is to say, well, okay, if Bitcoin stays where it is, okay, what would you expect? In other words, it doesn't change from where we are now, circa sort of $60,000. What would you expect to happen to gold prices looking forward? And the answer is that gold should get to something like 2,500 or so, based on those calculations, or probably if one's takes into account the presence of Bitcoin right now at these prices, maybe we're talking somewhere around 2,300. But you get the point. I mean, it's higher than we are now. On the other hand, if you said, well, okay, let's assume that you get more monetary inflation, but the gold market no longer acts as a hedge. And if people want to hedge against monetary inflation, they have to go into cryptocurrencies. What would be the equivalent value for Bitcoin? Staggering answer is $341,000. Now that's not a forecast, it's a conjecture, but it shows what could happen. And if Bitcoin has been allowed to get out of the gate and it's a now established market, and there's very little the authorities can do about it, then you might see, if people trust it as a monetary inflation hedge, it's got scope to go up much, much higher. Bitcoin is currently about 1.4 trillion US dollars in market size. The gold market's just over 10 trillion, maybe about 11 trillion overall. So you can see that Bitcoin from nowhere is catching up fast. Let me go on to fixed income and a bit about Forex. In terms of how we see the action in macro, this matrix sort of hopefully, excuse me, sorry, this matrix hopefully summarizes what we're saying. This is looking at the two dimensions here of central bank liquidity along the top and private sector liquidity along the left-hand axis. And what it's saying is that if you take central bank liquidity as fairly obviously reflecting the degree of looseness of monetary policy, and you take private sector liquidity, probably broadly as reflecting loose fiscal policy. So the looser the fiscal policy, the more private sector liquidity you get. That's actually a result of flow of funds accounting, but take that as a good representation. That basically means that in an environment where fiscal policy is loose and monetary policy is loose, you're in that top right-hand quadrant where bond yields are likely rising because of rising term premia, and you're getting a steep yield curve. Okay, that's exactly where we are now. If you're in an environment which is the top left, where you have basically had loose fiscal policy, in other words, lots of private sector liquidity, but actually a relatively tight monetary stance, which is actually where the US was until about a year ago, then you expect to see a strong currency. The dollar was strong, over that period, 2016, 2017, 2018, when we were kind of in that regime. To get the dollar a lot weaker, what you've got to start to see is loose monetary policy continuing and private sector liquidity low. Now, that could mean that fiscal policy tightens, but we know that's unlikely. But the other cause could be a drain of liquidity out of the US into foreign economies. And that's something I'll come on to later. But for the moment, what this really says is that what we should be focusing on is that top right-hand quadrant, because all the action in macro is going to be in bond markets and steepening yield curves. Now, here is the evidence of what is happening. Again, we show this chart religiously every month, I think now, and what it shows is another month updated of basically what the data's basically saying. This, by the way, is average yields through the month, the average yield curve. So it's not the end of month, which is, I think, would be nearer 1.6 or whatever, but it basically shows the general shape of the US term structure. So this is looking at the spread between US 10-year yields and US 2-year yields. The yellow line is our US liquidity index, and we've simply advanced that by 9 months, as the text says. So it's a leading indicator. Now, I think there are two things to say about that chart. One is, why does it work in this way? And it works in this way because lots of liquidity mean that investors are more able and more willing to take risk. If they're more willing and able to take risk, why should they hold safe assets like government bonds? Consequently, investors shift out of government bonds into riskier assets. And as they shift out, yields rise. And in other words, the term premium on the bond market tends to go up, pushing up yields and steepening the yield curve. Similarly, contrawise, if liquidity contracts, you get the opposite movement and the yield curve flattens. The long-term history is exactly the same. I've just looked at the last 20 years, but if you go back, even into the 1970s, you see this same relationship, and you see it for different countries. And as I probably said, a number of times before, back in wearing my Salomon Brothers hat, many, many years ago now, this was exactly how we used to think of trading bond markets. It was all about flow, all about liquidity. And, if those of you that are interested in the potted history, the yield curve was a device that was originated at Salomon Brothers by Marty Leibowitz. Up to that point in the mid-1970s, yields at different tenors were treated as separate markets. But Salomon was the first to think about yields and a yield curve as a continuum. And that was all about liquidity flow. The second thing to say is that if you look at the peak that you're getting now in US liquidity, that should be warning that at some stage you're going to get an inflection in the yield curve. That could come in two ways. Either short rates go up or long rates come down. I think we're at least 6 months from that point, and you'd likely be seeing yields of 2 to 2.5% in 10-year treasuries before we got that inflection. But that inflection may well occur, very likely to occur at some stage in the next 6 to 12 months, I would venture. But until that point, the steepening yield curve is underpinning cyclical stocks in our estimation. Let me say something finally about long-term risks. And there are two that we highlight here. One is what we call the debt liquidity spiral, which is broadly the ongoing risks in the financial system. And secondly, to focus a bit more on the US dollar. In terms of the debt liquidity spiral, one of the things that you repeatedly hear mentioned in the media, not surprisingly, is the debt overhang the world economy has got. The bars on that chart show IMF data on all debt worldwide across all countries they cover. And it shows all forms of debt: household debt, corporate debt, government debt. It excludes financial debt, in other words, intermediary debt, debt held by banks. But otherwise, it's all all debt in the economy. The red line is the pool of liquidity. The astonishing fact is that the two move up together. Why is that? And a lot of the reason is that debt needs liquidity for refinancing, and liquidity ultimately comes out of debt, because a big source of liquidity is repo borrowing, and government debt in particular, but also for some form of corporate debt, is used for repo, and that's a source of liquidity. So people will borrow against that collateral. In other words, you get this debt liquidity movement. Now, in terms of the debt liquidity spiral, this shows basically how the movement works. So in other words, debt starting from about 1 o'clock, debt allows the creation of liquidity. That drives the yield curve and term premia, comes back to affect the level of debt, which then rolls back to affect liquidity, etc. And what you see is that debt liquidity spiral. The reason for highlighting it is basically to say that if you get any downturn in liquidity, and that could come for a variety of reasons, central bank tightening, etc., or things like rising yields just because of strong economic activity, if that detracts from the value of debt and reduces collateral, and by the way, collateral fell by about 5 to 6% in value in the first quarter because of the sell-off in bond markets, that will have a negative impact, because it means that the pool of liquidity will come under pressure and it becomes more difficult to refinance debt. Now, that's critical because most of the wobbles in financial markets that we've had in the last 20 years, I would venture, have all been about the inability to roll debt over and to refinance. And what we say in the text here is that what you've seen in the world economy in the last 20, 25 years is the general theme of it empowering China, but I think we could also extend that economically to Northeast Asia. And what that has done is ultimately weakened the West financially, because it's forced the West to take on a lot more debt, partly in terms of the reversal of polarity in world financial flows, but it also has generally turned Western financial markets away from being new financing systems where they're trying to raise new capital investment to actually being refinancing mechanisms where it's all about rolling over the whopping great debt pile. Now, on that theme, the danger we've got is that liquidity at some stage go down, and we'll see another financial crisis like what we saw in 2007-8, maybe like what we saw in 2019, end of 2019, before the COVID crisis, when markets were shaken then by sort of concerns over taper tantrum or whatever. So basically, this is a reality we've got to watch for. Those central banks, the Bank of England being foremost in this, who are pushing for negative interest rates, are absolutely mad. If that's what they think is the solution, they've really been asleep for most of the last 20 years. What you need is liquidity in the system, not lower interest rates. Negative interest rates will encourage the take-up of more debt, and that's exactly what we don't want. So it will worsen the problem. And if those advisors are suggesting negative rates in the UK, they really are completely wrong. The next thing to say is that let's put that into context and to look at where we are in the cycle. And this is our liquidity cycle that we showed right at the beginning. The black line is basically a cycle that's been devised by Fourier analysis, and it uses an AI system to get there. But it basically looks at the underlying cycles in liquidity and tries to replicate them and project forward. And what you get is a cycle which seemingly lasts about 68 months. So that sort of 6 year duration, let's say, something like that. And what we've done is to put that against the liquidity data. It's not it's not a regression fitted model from that regard. So I think one can take a certain amount of comfort in that aspect. And what's more, the COVID or the COVID V that you've seen in liquidity, if that's what one can call it, is following almost exactly those waves or those sine waves or whatever one calls them. The peak is coming pretty much where you suspect it is. The downswing may or may not be, true to life, but that's what is being indicated. And that's saying that liquidity is going to be falling, or the rate of growth of liquidity is going to be falling, from now pretty much until the end of 2022 or there or thereabouts. Now, what does that mean for markets? In the short term, I don't think it means that much, apart from our concerns about a near-term shakeout. Liquidity is still growing. The time to get more worried is when it starts to go below the 50 line, because that will indicate a more serious squeeze. We're not there yet, but clearly we're emphasizing the markets are cyclical. I think the fourth quarter of this year could still be pretty good for financial assets. I still don't think we've got a bubble there. And I think prices of equities have still got higher to go, but there may be a better buying opportunity the other side of the summer, if we're correct. Let me finish on some thoughts about the dollar. This is looking at regional flows, and this is one of the reasons that we're concerned medium term about the dollar. And basically what it illustrates is capital flows into major regions. Now what you see here is the US in black, in red is Europe, in yellow is Asia. And basically the recessions, by the way, are shown, US recessions in gray. The annotations basically show where you've seen peak demand for dollars. And generally speaking, what you've seen over that period of 40 years is general downturn in the dollar because of, I think, general excess supply, but three big periods of strong demand for dollars. One in the mid-1980s, when it was Japanese insurance companies that were buying dollars as Japan liberalized its capital account. I think that was in 1984, 85. You saw that underway. So there was huge demand for treasuries then. Then you saw in the late 1990s, Asian demand for safe assets. And that was basically another instance that came out of the Asian crisis, and that went into dollars. And then what you've seen is the post-GFC, the 2007-8 global financial crisis, demand for safe assets coming out of the Basel III regulations. On top of that, you had a Eurozone banking crisis that caused the red line to go negative. It's now sort of more positive. And you also saw the China corruption crackdown, which saw a big outflow from China. Now, it's fair to say that capital outflows from Asia are still negative, and they actually look like they're worsening a little bit at the moment. But we think that the Chinese capital account is moving towards much better balance looking forward. Money is likely to go back into the euro area. It tends to attract cash, and maybe this big euro bond issue is going to be one thing that pulls money back. And so what we're left with is a period where we've got vulnerability in the dollar because of this large capital inflow that you can see highlighted there, really through 2014, maybe to date. It's still positive. Money is still net flowing in to the US, but clearly you can see that that peak or that spike, which is a concern. Secondly, if you look at the data from the US Treasury, this is showing foreign holdings of US Treasuries by one of their calculations. And what this illustrates is the holdings of dollars by foreign, this is foreign official holdings of dollars in blue on the left-hand graph. So that's largely foreign exchange reserve holdings. And then you also see holdings through the foreign private sector. Now, the collapse in the blue line is not necessarily indicating that Forex reserves have just been depleted almost entirely of US treasuries. They may hold dollars in other forms, but basically you can see there that the demand for treasuries is going down. If we graph on the right-hand chart, the holdings or the private sector holdings of treasuries in terms of trillions of dollars, you can see that move down from a peak of what, 2.25, $2.3 trillion to where we are now, which is about 3.8 trillion. So that's a loss of, $500 billion, over the course of maybe 18 months. That we think has had quite a material effect on US yields. And we've put there, the blue line is the term premium on US treasuries inverted. So as that blue line goes down, yields in the US rise. And that is consistent with what you'd expect from this foreign selling. So I think that that has further to go. I'm concerned about the dollar medium term. And what you can see maybe as a result of that is the vulnerability of the treasury market to rising yields as foreigners sell. So you've got a sort of double whammy going on. So I still think overall, to summarize this picture, and then we'll turn it over for maybe 10 minutes of questions. Number one, you've got still strong liquidity worldwide. There is an inflection going on in terms of growth, largely because of economies having so much strength that may well sap liquidity out of markets in the short term. That will give a window of a buying opportunity, maybe in the early summer months or whatever. Markets will rally again through year end in our estimation, and there are a few bubble characteristics overall. And as I said earlier on, our bias would generally be towards developed markets and towards the US and UK markets within the overall regional mix. Eurozone's getting a little bit cooked. It's not really it's not an absolute sell yet, but it's looking relatively unattractive. Bond markets yields at 2.5% US Treasury. Dollar, we think medium term weakness, although we've got no compelling strong view in the very short term. And gold and cryptocurrency keep going up. So let me turn it over to questions. I don't know if there's a chat that I can see. I'll try and see if I can find a chat box. There is a chat box, so if anyone wants to unmute or answer any questions, I'm delighted to spend the next 10 minutes or so going over that.
Michael.
Yeah, hi. Hi, Mark.
Hi there. Hi, quick question. You started off with excellent presentation, by the way. Thank you for that. But you started off by talking about how the digital yuan and potentially the digital ruble could be a long-term competitor, contender for reserve status or to upend the dollar. I'm puzzled. I just want to understand, do you think that the people in the West will put their money in a digital yuan? I would have thought that the big concern about a digital yuan is that the banks are going to have a problem transferring funds and doing normal banking things, so people will be able to transfer funds a lot more easily. I didn't necessarily think it would hurt the dollar, but please explain.
Well, I think the thing is that what you're doing is you're taking transactions away from the dollar. And so the argument that I have in this is that anything which goes outside of dollar channels is a lack of demand or slowing of demand for dollars. And in that regard, it potentially should weaken the dollar because you won't need to hold so many dollar inventory, as much dollar inventory, if you like, for those transactions. Now, the question is, will it happen and where will it happen? I think there's clearly a lot of question marks over the viability of this from the Chinese. But the more and more that China uses it successfully itself, and the anticipation is before long there'll be 50 million people using it. And I think the Chinese, if I'm not mistaken, have got an aspiration that by the Winter Olympics in Beijing, they're thinking of 100 million users. So these are begun to get pretty big numbers. So that's point number one. I think you've got to see this in the Chinese context of what they're trying to do overall for their financial system. And it's very, very common to hear, comments about how fragile the Chinese financial system is and the banks, et cetera, et cetera. We heard that a lot about Japan in the 1980s as well. The reality is that their financial system is a lot more robust than the Western system, but it's actually very immature. And the reason it's a lot more robust is that the strength of the financial system or the robustness depends on how good the liability structure is. And if you've got liabilities in the financial system that rest on somewhat wobbly collateral or shaky or flaky shadow banks, then you've got a question, which is what the West increasingly does. And that's where you get financial crises. In China, that doesn't happen because the state owns the financial liabilities. So it's much more secure in that regard. So I think point number one is that, don't expect big financial problems in China from a stability point of view. It is very stable. The problem they got, though, is it's very immature. And China is ultimately a re-exporter of dollars, and it can't afford to do that in the long term. It needs to start exporting yuan. And part of their strategy, which is the thing I wrote up in my book, Capital Wars, is that what they're doing is there's a three-pronged approach. One is to create the digital yuan as a rival to the dollar. And the Chinese are absolutely explicit about this aim. They want to unseat the dollar, particularly in Asia. The second thing is to open up their bond market in particular, but financial markets in general, to foreign capital. The last 12 months has been hugely successful in doing that. And the third thing, which is probably the crucial thing in terms of our discussion here, is to create a trade credit market in yuan. And that will involve the banks basically doing more lending in yuan. Now, if you look at the Chinese capital accounts for 2020, there was a noticeable pickup in credits given by Chinese banks overseas. And that, either means that it could mean, I accept in part, that there was a lot of need for credit last year during the COVID crisis, and maybe Chinese banks just stepped up. But it could equally be there's a lot more invoicing going on in yuan. Now, the reason for making that point, and in particular highlighting trade credit, is that that's exactly how the dollar became the prominent world currency it is after World War I or during World War I, because as the Brits stepped back and sterling wasn't allowed to be lent internationally during World War I, the US dollar was, and the US went from zero to hero in terms of use in foreign exchange reserves. So I think that's what's going on. It's a long-winded answer, but I think that China is in the ascendancy in terms of this aspiration. It's going to take some years to get there, but I think the very fact that Russia is following this model, maybe no surprise, suggests they're getting ever closer. It's a serious challenge. What does the US do? It accelerates its digital currency program. It tries to get, I think, the SWIFT system more digital. SWIFT is not a digital currency system, it's a messaging system, but it needs to change. And I think that one of the things that basically will accelerate this if it occurs is that something like XRP, the Ripple currency, which is a bit in the doldrums at the moment, or certainly with the SEC, that needs to basically sit above all these central bank digital currencies in the West as a bridge currency. And then you've got a digital system to rival what the Chinese are building. But the Chinese are at least 3 years ahead of what other people are doing as far as we can see. Let me take another question from Jonathan, which says, do you see evidence of in liquidity measures to support the current narrative that US economic outperformance this year will drive the yield gap and the dollar higher against other major economies? The answer to that is that there is evidence in liquidity data that the US economy, the economic outperformance will continue. Okay, I think that's clear from what we see. Does that mean the dollar goes up? I'm not sure about that, because at the end of the day, what you've got is still a very loose Fed. And although the fiscal policy is loose and the private sector is getting liquidity, the problem is that is at the margin starting to flow overseas. And what you're starting to see opening up is two things, I suppose. One is the trade deficit is widening again. And secondly, the evidence I just gave you that foreigners are beginning to sell out of dollar assets, or let's say out of US treasuries. And that's clearly a concern. So I think the net of the net, in my view, is I don't think the dollar is going to do too much this year, but I think the long-term trend is downwards. And I think as regards the yield gap argument, I mean, I've never been persuaded by the evidence that yield spreads drive currencies. I just don't think it's there. Certainly the forward market is a very, very bad predictor of currency movements. And all the empirical evidence shows that. And if you look at bond yields, I don't think it's there much better. I mean, the data that we use, which is flow of funds, has much more powerful drivers, a much more powerful driver of currencies than relative yields. So I think the first part of what you say is correct. Second, I'm more skeptical about. Do we have any more? I can't see any more in the chat, but if anyone wants to unmute and say anything, I'm happy to try and answer some more questions.
Michael, it's Stefano. Can you hear me?
Stefano, yeah, hi, can.
Hi. I missed the first few minutes, sadly, so you may have covered it, but forgive me if so. One thing that was touched upon in the past as well is the fact that when the Fed set out its current buying rate of treasuries plus, for some reasons, mortgage-backed securities, that was against a very different forecast of treasury issuance, because the multiple rounds of stimulus were not even on the horizon, let alone implemented. Now, the drawdown of the Treasury General Account has sort of funded the initial wave of stimulus, but eventually that will run out. Since I don't think any of us believe that the Fed will ask the private sector to fund any of the forthcoming deficits, what excuse does the Fed need to flip the current talk on tapering in the long distant future to actually a talk about doubling the current rate of purchases, which is clearly where they have to be by the end of the year? Otherwise, the private sector has to fund, and then the equity market will go down. Yeah,
and I think that's you know, that on the horizon is a worrying dimension, and I think that, you know, I share those concerns, but I think the Federal Reserve has got to do something here in terms of upping its stimulus. Now, when I said right at the beginning, which you may well have missed, I said that if you look at the pool of liquidity, it's currently about just under 160 trillion and worldwide, but we think there's probably further growth through this year in the next 9 months, of probably another $20 trillion worldwide. Now, that is taking into account, or within that figure, the Federal Reserve basically meeting a similar proportion of treasury demand or treasury supply that it has already. So it's basically been taking up, from memory, something like between 1/2 and 2/3 of debt issuance. And I think that will likely continue. So I think they will have to step up these monthly figures, yes, on that regard. Is that going to be enough to stop yields rising? No, I don't think it is, because I think the problem that you've got, the problem that the US has, and maybe a lot of central banks have in terms of yield curve control, is that the yield curve background, or the bond market background, is radically different to the last time that it was engaged successfully in the 1950s. And that is to say that the banks were big owners of bonds then, and they could be told what to do. And secondly, foreigners didn't own any. And now what you've got is a situation where the banks own, you know, some but not very much treasury now, but the foreigners still own a sizable chunk. And depending on which figures you look at, it's somewhere between 25 and 35%. And the reason there is a gray area in those estimates is that the form filling in as to who owns treasuries is voluntary, and there are clearly, you know, there are also nominee accounts. So it's a little bit unclear what the true number is, but it could be somewhere between those two numbers. If you said 30%, you wouldn't be far out, and 30% is going down. So as that chart that you can probably just see on the left-hand side of my screen is showing, you've already lost $1 trillion, virtually $1 trillion of foreign holdings of treasuries, you know, in the last 5 years. So, you know, it doesn't all go well in terms of the long-term balance. So I think that the pressure on yields is up. I think the Fed has to do something, but it's not going to do enough to thwart things. But that will just put more liquidity into the system, and it will help this whole picture of rising asset markets. But ultimately, there is a constraint, and that constraint, as I said, coming back to the cycle, is that if you get this overissuance pushing up yields, that clearly is denting the value of collateral, and that will start to have a negative impact on the supply of liquidity, which will then, hasten the declines here, and that reinforces the cycle. Do we have any other questions? One I can see just come in here from Mark, which says, Euros, won't capital spill from bonds to equities as inflation returns? At least capital has a chance of beating price inflation in equities, whereas guaranteed loss with negative yields. Yeah, I think that's, I think that's absolutely right. I think the issue that you've got, the Eurozone issue is a more complicated one. But I think the general point here is that if you look at a period of rising inflation, gently rising inflation, the first stopping point is to say that investors basically quit bonds and they go into equities. And that, I think, is the process we've seen unfold through the first quarter. And I think the underlying trend is still there in that regard, partially everything else I've said. Once you start to get more runaway inflation, of which I would say is an inflation rate above 5%, then all financial assets will be hit. We're not at that point, and don't think we're going to get to that point, because you haven't got the mechanism for the transmission of inflation beyond those sort of thresholds, which would be, a labor market that is very tight, wage demands that are going up strongly, etc., unionization, oil prices, you name it. So I don't think that's there. On the question of the more sort of complicated question about yields in Europe, I think the point to remember in all this is that the fundamental flaw, as far as we can see, in the Eurozone system is the fact there is not a safe asset in Euro terms. The Euro safe asset, when I get my terms muddled slightly, but the Euro safe asset is the German Bund. So it's a national safe asset, not a pan-Euro safe asset. And that means that whenever there is a problem in the Euro area, everybody flies into bunds, and bund yields go down, creating this yield gap, and that causes tremors across the system. And that still is a major issue. That safety premium on bunds is going to stick around, and therefore what I think you've got there is you've still got the basis for lower yields in the Eurozone, principally on bunds relative to Treasury. So I think that's a structural issue. But I think that your point about a move into equities vis-a-vis bonds, I think absolutely. And I just can't see how bonds are going to perform in this environment at all. We're in, as I maybe said last month, and we'd already had by that stage the worst run in the bond market since the 1950s. Not in terms of duration, rather than a sell-off, rather than extent, but so it goes on. Do we have any other questions coming through? One more. Okay, no, that's thank you. That's okay. Very good. Okay, thanks everybody. Have a great month, and we'll re-engage in a month's time. Any questions, you've got further questions, just email us and we're delighted to help. Thanks again. Have a great time. Thank you.